Hi, this is Jonathan with the Strategic Multifamily Investing Podcast, and I have with me Mr. Let me see if I get this right, Anthony Scandariato.
Wow, that was great. Well, maybe because we practiced 10 times before.
Yeah, or I tried. Yeah.
Or you're just good.
Cool. So essentially what I wanted to do with this set of interviews, beginning 2021, was to interview experienced operators that are out there, people who have done the thing before, to kind of learn some of the habits, oh, I wish I'd known this, I would have done it this way, or this is what we do, and pull out some additional traits. I think, someone says success leaves clues. I believe that was Jim Rohn. I think it was Jim Rohn. So I want to kind of pull that out and have that conversation. And so thank you very much for having that conversation. With that being the case, do you want to just kind of introduce yourself and kind of how you got into multifamily?
Sure thing. No, thank you so much, Jonathan, for having me on your show. So how I got into multifamily. So I had a start even before real estate. So to take a step back, I had a startup company with actually in college and with a couple of partners, and I was in a completely different space.
What kind of space were you in?
And it was in like consumer products and retail. It was like sunglasses and sweaters, colleges. So, it was something I was kind of interested in. It was kind of cool, but at the same time, I was missing something. So I was able to step back from that and pursue real estate. So I got a job at another operator after I left that company, and they were focusing on the operator was focused on Class A multi-tenant office.
Okay.
So it was kind of a bear, at least what people are thinking of right now during COVID, of an asset class. I just thought it was really interesting. If I can kind of understand office, I think it's a very challenging asset class. If I can understand that, I think I could understand other asset classes pretty easily. Maybe hotels are very, very difficult too, but multi-industrial.
Can I ask another question real quick?
Yeah.
So you had a startup that was in the whole retail space, right? For colleges and universities and things of that sort, selling, eyeglasses and other things. What made you say, I want to go Class A, commercial real estate from that retail space?
I'm not a product guy. I'm more of a service-based guy. And that's kind of why I got into the real estate business. That was really what drew the line, to answer your question.
Got it.
So was able to, to make that transition pretty easily because there's a lot of transferable skills to the real estate industry that I learned.
Sure.
Entrepreneurship, real estate, as you know, Jonathan, very entrepreneurial. So to some extent. I worked, like I said, for another sponsor, understood office, did a lot of deals there, helped, raise capital there, help property manage, help asset manage, help pretty much do everything, and learned a lot. So at the same time, how did I get into multifamily? I was buying some smaller duplexes on the side while I was working.
Got it.
And then I met who's my current business partner now. I met him while I was working. And we were able to buy some properties together and do some nice refis and a couple sales. So we were building up a track record, and that's kind of when we got into the larger 50 plus units, which I know you specialize in as well, syndication sort of model. So that's what we, focus on today. And we're based out of the New York metro area. We have 200 units currently in our holdings. It's about 25 million AUM. And we're picking up another 50 units in September. Actually, another 60 units in September. So we'll have, close to 300 by September.
Okay, so this is very interesting. There's a bunch of questions I have. So
Sure.
You got your start buying, some duplexes, triplexes, fourplexes, right? Some smaller multifamily, residential kinds of things that you actually can go out and get an FHA loan for those people that are thinking maybe doing some house hacking. That might be a way to do that. Were you house hacking?
I still house hack.
Oh, there you go. So you guys were house hacking, and that got you in. But my next question is, you didn't go, you went small and then you went big. I mean, would you have gone bigger out the gate, or do you think going smaller and then going bigger into 50 plus units is better?
I think there are many different ways to skin the cat. So you could have partnered up with I could have partnered up with another operator on a bigger deal, maybe help them raise some capital or whatever.
Right.
I just thought I just thought if I can kind of learn everything by working for somebody else, and then also when it's my own money involved now, if I can learn what I can, kind of on my own, learn how to deal with tenants, how to deal with contractors, and have my own skin in the game. I think it was definitely different. So
you could actually feel it. You could feel the decision.
You actually feel it. Yeah, you could feel the pain, but it wasn't pain. So how I got into multifamily was that first duplex I bought returned me 20% of my money the first year. Wow. And I was like, wow, this is nice.
That's real nice, yeah.
So just the ball kind of kept rolling from there. And I after that I bought another duplex, but I brought on another investor with me, split it 50-50, and we sold it. We made like a 40% return in a year. And then I met my business partner now, where we started to buy bigger and bigger and bigger.
So when you were doing that duplex, you were just working for that Class A multifamily. That person who was that operator, was that one of your partners when you went into your first 50 unit or so?
No. So
how did you find that partner?
My business partner today?
Yeah. Is that the same one you bought your first 50 unit with?
Oh, sure. So the first 50, let me take a step back. So okay. I started with this was the gravitation. So it was a 2, a 2, a 2, a 10, a 10, a 13, a 20. So it was about 70 total. And then that was just between a partnership with me and my business partner, and that was it. 50 in December, that was about 20 people. 20 investors. So that's how that was structured. So I'll take it now. We got another 70, another 50. That's, again, the same thing. It's 20 investors.
Okay. So your current business partner has been with you kind of since day one.
Since day one. Yep.
How did you find him? How did you find that business partner?
He's actually referred to me by someone at my workplace. Actually, he used to play football, college football, at the same school with him, and thought it would be good for us to connect because he was looking to be active, and he's younger, and we just hit it off, and we started acquiring properties and doing well. So
you've said a couple of things here that are definite trends that I've heard from others. Number one, going way back in your day, you recognized that you were not a product guy, you were more of a service guy. So getting to really know who you are, what kind of things that kind of, light up your insides. And then number two, you recognize that you were more entrepreneurial than you were, say, the same thing over and over and over again. I mean, there's nothing wrong with those people who need that consistency. We could use them on the LP side of things or the limited partner side, people who want to be passive investors who really don't want to be, in the throes day to day. That's fine. You can leave that for the GPs or the general partners, those that are taking on the deals, but then you could be a passive person.
Sure.
You also, so am I right about that?
Oh, hell yeah. Yep.
Good. I like that. I love that answer. So, and then another one is that you found a partner. Why, let me ask this question. Why did you think that you needed a partner? I mean, because you're doing a duplex. Did you really even need a partner?
Yeah. So the reason we needed a partner, at least I needed a partner because I didn't have the money to take down larger deals.
There you go.
That's number one. But also number two was it wasn't enough for me to leave a W-2 and pursue this full time. Kind of at the start, even with the first 10 unit and the second 10 unit at all. So we were both. He would, he kind of oversaw the management while I was still working, and then on the weekends I would help manage. So it was a perfect balance.
So he was not working. You just were referred to him by someone at work. He just didn't work with you, right?
Retired. He was retired, and now he's active with our business.
There you go. He's got the gray hair. I forget who it was. I think I want to say Shakespeare. It was said, trust the guy with the gray beard. So, not that they have to be gray, but that they're seasoned. Again, they've been in the business. They know the business. They may have access to capital, things of that sort. That may be a way to be able to do that. Again, I've mentioned before, even on this podcast, I believe, and in conversation, I ran into last year, a group networking conversation when I was at Michael Blank's conference, and I didn't know I was talking to Neil Bauer. Yeah, great guy. I didn't know I was talking to Neil Bauer, and he was just like, you need to partner with someone. And I'm like, no, I'm an operator. I want to go. It's like, no, you really don't know the business. Partner with somebody who knows. And again, that's another rule that's out there. Let's see. You
also a great guy, Neil.
Neil, yeah, really, really, really smart. You've got 200 units under management. You've got 60 that you're tackling. So is your sweet spot like the 50, 60 kind of thing? Because some people go straight to the hundreds and hundreds of deals and things of that sort. But
my opinion, there's a lot of value, I think, that's off the table, or that's a lot of meat on the bone that's on these 50 to 100 unit buildings. Even though they're a little bit smaller, I would say the middle market. Our average deal size is 5 to 20 million. It's been on average like 6 million, give or take. So that's kind of like right in the middle. You're not really competing with the institutions. You're usually buying from generational wealth or mom and pop ownership, where there's a lot of upside for professional management to come in and increase rents, make renovations, decrease expenses. A lot of value. That's what we look for. So it's harder to find that, in my experience, with some of the institutional product that's 500 plus units. And you're buying at really low cap rates on those. And usually, I personally, we bought deals in the 10 caps in New Jersey, so you don't see that too much today, but
no,
at all. But
yeah,
with upside, I'm not talking on it with upside. So we usually always buy for in-place cash flow to begin with. And, I would say that a lot of these.
I'm sorry. I apologize. I keep interrupting you here. I want to make sure that other people who probably don't understand, industry lingo, as we say, we can kind of explain that. What is in-place cash flow?
Yeah. So in-place cash flow. So I mentioned the word cap rate. So if you were to buy a property all cash and it was at a 6 cap and everything goes, the revenues and the expenses stay the same as what you originally thought they were going to be, you would make 6% on your money. That's what it is. It's just one metric to use to evaluate real estate. There's many different metrics, but that's the main one. So what's your going in yield on your investment? And usually there's leverage involved, so you're not always just going to make 6% because sometimes you'll borrow at 2-3% on that 6%. Right. So it's just a metric. That's all.
Cool. So how are you doing your underwriting? Are you using Michael Blank's syndicated deal analyzer? Or, okay, cool. That's another good tool, another great tool for people to use.
Yes. I have my own former companies as well. It was a little bit more too complicated for multifamily. Mickles is good. There's a few others that I used as well, but Mickles is pretty good.
Cool. So you're in the New Jersey market. I know some people were kind of scared of that because, there's rent control, I believe, in New York, right? And
sure.
And also too, the numbers happen to be a lot larger and they're not getting 10 caps or whatever. So what's your secret? You don't have to give us all divulge, but everything, but why New York, if you don't mind me asking that?
Yeah. So we own in New York, New Jersey, and Pennsylvania. Okay. We don't own in New York City. We don't own in the boroughs. We own outside. We don't own all the way upstate either. We own in some on the border, like Orange County areas. So there's no rent control in those areas. In New Jersey, the areas where we don't own in Hoboken. We don't own in Jersey City. We don't own in Union City. We own kind of like in the middle of the state. There's no rent control. And then same thing with the areas in Pennsylvania, where we own, there's no rent control. So I would probably never buy a deal with rent control. And if it has rent control, it has to be very, very limited.
Okay. So, I mean, we're in the middle of COVID and you guys have just closed on another, 60 some units or how many units?
64, yep.
64 units. Talk to me about this. I mean, we're at the time of this recording is July of 2020.
Yep.
We probably are now four or so months total as a country in COVID. And a lot of people have been really concerned about buying. Some investors are on the side. What made you all feel so confident to go and tackle this deal during this time?
Yeah. So as I went back to before, the in-place cash flow, the cap rate is high. We had it even before COVID, and it was off market. And the value that we picked up the property for was, if they brought it out officially on the market, was probably 10 to 15%, lower than if they, listed it with a broker like yourself in the first place. That's why we were attracted to it. It was 7 cap with, 20, 25% upside in the rents day one. So, and we already owned in the market. The 50 unit building is right next to this building. So you have the economies of scale. Per unit pricing was low in comparison to the comp still. It just still made a lot of sense.
And because you were already there, management, you could share management, because I'm pretty sure you don't have on-site management.
Exactly. So now we have on-site management, because we just hired, actually yesterday, we just hired somebody to take over. And we just saved $20,000 on payroll for the deal, So there's value that we're able to add just because we're already in the market. If this was a new market, and I probably wouldn't be as gung-ho with that, be more cautious, just like you said, with the sidelines. But this was a different situation.
Cool. Well, you guys are definitely doing it up like gangbusters. So someone like myself, we're still, waiting to hit that, get that one or that first property or whatever that is. What are some of the lessons learned that you think a new potential operator or GP should do or learn?
Yeah. Like you said before, don't be afraid to bring on partners, even if you're giving up equity or whatever it is. Even if you have to give up something, it's really not the worst thing in the world. It gets your foot in the door. Don't be greedy. Just make sure once you get your foot in the door, you start producing, your life will turn around. So at least your real estate investing life will turn around. So that's a piece of advice. Don't be afraid to partner early.
So when you talk about partner, you're talking about bringing on additional GPs. Are you talking about just, okay, cool. And how many, go ahead.
I'm talking about that, GPs or joint venture partners, however you want to structure it. But I wouldn't take on limited partners yet, at least from on a large scale when 20, 30 people in the deal when you never had any experience really before. And if you're bringing them in somebody else's deal that has experience, then yes. But don't try to do that unless you have somewhat of a track record.
So then, next question: what about because you mentioned don't bring on a bunch of LPs if you haven't dealt with them. So in terms of your systems right now, doing asset management, we've been talking to some other companies and things like that. So if you don't mind, what type of things are you doing with asset management or investor relations? What kind of systems are you using?
Sure, it's really important to have your systems. So for investor relations, asset management, we used InvestNext. So they're relatively new-ish. There's a bunch of companies out there I'm sure you're aware of, Jonathan.
Yep.
But InvestNext is a newer one. They're very flexible with the pricing. They don't kill you with startup fees. They charge you per investor, so it depends on how many you have, and it's not that bad. And then in terms of property management, make sure you get your software, accounting, all that in place. We outsource our accounting to a third-party company, but Buildium is like the property management, collections, etc.
Okay.
I think I forgot to mention, Jonathan, we self-manage all our properties. Just because.
Okay.
Yeah, just because.
Why did you choose to self-manage?
It's more of a track record thing. So I think if we third-partied some of the management on a couple of these value-add deals, I would be, scared. just because I don't, you know, I wouldn't know what they were doing half of the time. and especially when you have value add deals where you're trying to go in there and raise rents. Sometimes we're raising rents like 40%, and you have to have that conversation with the tenants. It takes the right person to do that. I mean, like, I'll personally have that conversation with my partner, and we've been successful. So it's not a job I would. What's that?
Okay, so take me into, because there's a couple more questions that are here, but that one is like jumping on me right now, because right now within our country, I'm from the Washington D.C. area, and there's been a lot of gentrification, right? Where investors have gone into specific areas and they've renovated, they've done their thing, and then they've driven up the rents significantly. I think 40% is not incidental. Generally, in single family homes, we're talking about a 5%, maybe 10% increase, yearly. And that's what people, kind of look at. But going to 40%, help us understand, number one, the conversation that you're having. Are you sending a letter first, and then are you sitting down? And then I want to go ahead. I'll stop there. Are you sending a letter first?
A couple of things. I know it might sound bad on the surface, but when we always buy a building, we buy it for in-place cash flow, and we look at where the rents are. Sometimes these rents haven't been raised in 15, 30, sometimes 30 years. They haven't been raised. So for someone paying $800 for a 2-bedroom apartment in a decent area in New Jersey, when the market today is $1,500, that's a reasonable conversation to have. And usually what we do is we do offer a discount to more, if that is the case, which it has been on a bunch of our units. We'd always offer a discount, because if they say no, they got to move. So where are they going to move to, and what rent are they going to pay when they move? It's going to be more. So and there's no rent control. So we always offer them a slight discount to where they would be if they had to move out, and we always offer improvements. Say, hey, how do you like your kitchen? Is there anything you'd like us to improve? Like your countertops, are they good? Do you want us to come in and put some granite in there? Especially if the rents are that high, you're able to spend a little bit of money on the units. Would you like us to change? Sometimes they don't want you to do anything. You want us to help you paint? Like, there are certain things that we don't just go in and say, hey, we're going to do this. Here's why. And we always list out the comps. We always list out what improvements. We walk every single unit before we close. We always list out what we think they might want. You need new blinds. I saw all your blinds were screwed up. You need new blinds. We're willing to do that for you. So as long as you're willing to work with the tenants, it could be pretty challenging. It could be it's definitely a shock to people. But at the same time, it's also not, because they know they've been getting a good deal for many, many, many years. And we try to work with everybody too. So depending upon the situation.
So you truly are improving the asset, and you truly are working with the tenants and things of that sort.
Yep. Absolutely.
I want to ask a question, but I don't think it's fair, so I won't go there.
Okay. You can ask it though.
Okay, I'll ask it. So, a lot of times when investors are in these areas, and we're forcing appreciation because you're putting in the granite countertops and you're doing those, and you're showing the comps that are in the area, and you could potentially again be displacing people. I mean, how do you feel about having the moniker potentially the big bad guy?
Sure.
Who's
that's a good question.
Gentrification.
Sure. So no, absolutely. So if that happens to be the case, we help them. We help them find a new place. We give them some sort of guidance. We have, many different assistance programs that we have relationships with to help them, help guide them to new places. We have many different relationships with realtors that, even if it's not the same town, hey, how's the town over? Is it $200 less than what this town offers? We always try to help them. I've actually relocated tenants from within our building. Like if they're renting a 2-bedroom, they're like, you know what? I don't even need a 2-bedroom anymore. Give me a 1-bedroom. I'll relocate them there. So we always work with the tenants, and we've been fortunate to not even be. I see exactly what you're saying, to like be put in like the big bad landlord light at all, just because like sometimes what I see a lot in the cities, and particularly with DC, they just send a letter out and they say, hey, here's your rent increase.
Right.
And we actually like call them and we say, hey, how you doing? Want to get to know you a little bit. How's the apartment? Anything you want? A lot of landlords don't do that.
So you actually care. That's the key. You actually have
Yep.
care, and it's not a facade, right? It truly is, at the heart of what you're doing. And I think by you self-managing from the beginning all the way until now, you've been able to develop that acuity to be able to have that caring, empathetic, ear that some other investors may not necessarily have, because again,
I don't see it at all. Yep.
yeah, I'm just sending you a letter and just going out there. So to
Yep.
kind of, latch on to that care, within COVID-19, with all the pandemic going on, what have you been doing? What are you guys doing right now to, to care for those tenants that are in your buildings? I mean, what are you seeing? What kinds of things that, are you doing at the tenant level?
Yeah, it's a good question. So we've been pretty fortunate with our collections. For the most part, they've been north of 95% every single month since COVID hit. So we've been very fortunate. There are a few, straggling. We worked out payment plans with the tenants who are kind of catching up. There's not many of them. And typically what they're doing is they're just paying late. Like they're paying for, let's say they're paying for July on like July 23rd instead of July 5th. Like they're still paying because they know that this will be over, the COVID, and they know that the last thing they want to jeopardize is a roof over their head.
Right.
At that point in time. We've worked out different arrangements, like I mentioned, the downsizing from one unit to another if there's vacancy for a cheaper price. So it's always situational.
Are you providing like mass and other access to resources? I know that some other landlords are doing that.
Yeah. So we sent out a mailer on COVID resources when this first broke out. We sent out a letter like, no big gatherings for, a couple months, whatever, indefinitely until we know what's going on. And pretty much everybody's been compliant. We haven't been offering masks. We've been suggesting it. And I've instructed all our supers to clean the hallways a little bit more than they should, sanitize. So, it depends on how many units you have also, I think. We have, our units there's like 10 properties within those units. So the 200 units right now. So, it's a little bit different than like a 200 unit complex. So each super is directed to do something different.
Okay. So then some investors and some, apartment owners are also seeing COVID related that there is a cliff at some point in time. Right now, some people are saying that the rents are, artificially inflated and propped up, because of the government programs that are out there for unemployment, et cetera, which I believe end at the end of this month.
Yep.
Yeah, July 2020. When we're recording this, I mean, do you see that as well, or are you optimistic, you're bullish moving forward, or are you bearish, moving forward? What are your thoughts?
My opinion is, and we don't need to get political here, but my opinion is that they're gonna do something. And it's my opinion. Nobody knows, but I think they're gonna do something. It's not gonna be $600, but it's gonna be something. So, but let's say they don't do anything. Let's say it's not extended at all. I do think we're still in a good spot because my price points in general are around $1,100 to $1,500. And I think.
And where is that in the market in terms of rents in general, the areas that you're in? Is that on the high side, or because
it's in line. It's in line, but you get also where we're investing, at least right now, is anywhere from 45 minutes to an hour out of Manhattan. So I've seen a lot of people kind of gravitate towards where we have the properties, just because it's a lot more affordable, and they're working from home now, so they don't need to commute. So I do think we're definitely benefiting from it. During COVID, my leasing is still the same as it was before. Actually, it ticked up. My rents haven't gone down; they actually ticked up. So, it depends. You have to really understand what you're buying in the first place. I wouldn't buy a Class A luxury apartment building at a 5
Wow.
cap. It's
Wow.
just with no upside. We always look for those workforce housing situations. There's a problem in this country on workforce housing in general. How many units we have to build per year or renovate to kind of keep up with the demand, even after COVID or during COVID. So the thesis is there. It makes a lot of sense. Fortunately, to my knowledge, not many of my tenants were laid off. I know maybe say 5% of my tenants were laid off. So it's not a crazy number, not a huge. Some of them were furloughed that reduced hours, but they're still able to afford $1,000 in rent.
Got it. So then, well, thank you very much. I mean, no one has a crystal ball. We hope that there is going to be something to help everyone out, with this, and especially moving forward, as a lot of the experts are saying that, come fall, winter, it's going to be a little challenging on a lot of different fronts. It'd be great to, I guess, have that to support people having, if you will, a roof over their heads. I guess I want to say thank you again for joining us. But my last question would be, I have a couple more. But,
go ahead.
What I guess, what are you looking for? What's your next move? I mean, you mentioned that you have now, you're close to 64. You're about 200 plus units. You're looking for another 60 in September. But, are you still looking in that 50, so range? Are you looking to break out? Are you looking to consolidate? What is the, I guess, the business plan for you guys moving forward? Yeah.
Sure.
And that's number
one.
one.
No, great question. It depends on the deal. I think, I'm looking at 100 units, like a 100-unit deal right now. The key is
New York, New Jersey area. You want to stay in that market?
Yes. Okay. Yes and no. I'm looking at the markets that I know in New Jersey and New York. So, but I'm looking at something in Florida right now. So I'm getting more comfortable looking at a state.
Got it.
And that's partnering with somebody else. Again, kind of goes back to partnerships. Investing where is key always. And then, if you want to get out of market, make sure you partner with somebody who knows the market.
Yeah.
So what happens after, who knows? Who knows what's going to happen tomorrow? But I think we're on a good path.
Cool. Well, how do people get in contact with you to be able to, potentially partner with you in the future, or,
Sure.
pick your brain a little bit more? How do they get in contact with you?
Sure. Yeah. So you can actually download. We have a special report on our website. It's how to leave your 9 to 5 through financial independence. You can download it for free. It's a little report. It's I think 6 pages. So we offer that on our website, redknightproperties.com with the K. It'll pop right up, and put your email in and you'll get it. And then you can actually book a call with me from our website as well, if you want to learn more.
There you go. So this is Anthony Scandariato. Hold on.
You were so good in the beginning.
Okay. Scandariato. Sorry. I messed it up. I was almost there. Almost.
Scandariato. Almost there.
Scandariato. Thank you so much, Anthony Scandariato.
Thank you, Jonathan.
Us. This has been great. We've learned a lot. I guess one of the last things that you mentioned before is, focus on workforce housing. There's a need there. That's the, generally the BC class type housing. It's not the, the shiny, brand new type properties where, the cap rates are very low and there isn't very much upside. Partner. We've learned partner as much as you can. Don't focus necessarily on the passive investors. Focus on those other active investors who may have already done the deals before, may actually have the cash, and don't be greedy. Give up as much as you can in the beginning so that you learn the process and move forward. In their model, they don't outsource management. They keep that in-house. And so they have proper management systems in-house to be able to deal with those things. So many different things that he mentioned, and I welcome everyone to reach out to Red Knight Properties and download that special report and get on the phone with Anthony as soon as possible. Listen, thank you again, and we'll be talking soon.
That's good, Jonathan. I hope so.
Absolutely.